Hello fellow entrepreneurs. Have you ever been given a bill that turned out to be way more than you were expecting? Like the mechanic, for example, like the one I got this morning. Eesh. Right, well, because of that, I thought I'd just quickly come and smash out this video because there's a really good lesson to take from this. So let's take that feeling of having been given that big bill, and let's just say you've just left your accountant's office, and let's just say they've given you a massive tax bill and you are left standing there thinking, oh, how am I going to pay for that? Better yet, I bet you wish you'd known about it sooner. Perhaps you're one of those lucky few that's never had any of this happen to you before, in which case hats off to you, lucky you. But you might be terrified that it might happen to you, especially in terms of the tax bill. What if I told you that there was one thing that you could do every year that meant that you wouldn't have to live in fear and you'd never leave your accountant's office feeling that way ever again? Just one thing. Let me tell you a secret that will mean that you will never have to suffer the shock of a big, massive tax bill ever again. Here we go, drum roll please. Tax planning. Bit anticlimactic, don't you think? In this video, we're going to go through the basics of what tax planning is and why you should be doing it every single year. As always, there will be timestamps in the description below because I value your time. You already know why you are here, so my fellow entrepreneurs, let's just do this. What is tax planning? Investopedia defines tax planning to be the analysis of a financial situation or plan to ensure that all elements of a situation work together so that you pay the lowest amount of taxes possible. The ATO state that you have a right to arrange your financial affairs in such a way that you keep taxes to a minimum. So what is tax planning? Well, I like to think of it as the arrangement of your business and your personal affairs in such a way that you pay the lowest amount of taxes possible across the family group legally. It can range from the simple end of the spectrum where we look at your deductions and how we can maximize your deductions, right the way through to restructuring your business and using different structures to be able to help spread the load of tax around the family group to be able to keep taxes to a minimum. Is this something that you can do by yourself? Absolutely not. You definitely need to be talking to an accountant before you tackle this area of tax planning. This is not something you want to be doing entirely by yourself. Get it wrong and the penalties can be huge. Get it right and the savings can pay for your next holiday, can pay for a car, can pay down on your mortgage. You get the idea. There are a couple of things that we just need to note here. So the first one, and this is the biggest one, is we are doing this legally. You are not allowed to break the tax laws in an effort to keep your taxes to a minimum. And in fact, a word to the wise here is that you and your accountant can both go to jail if you are caught doing something illegal to avoid paying tax. And the second thing is that we are actually not trying to get out of paying tax completely. We're just trying to minimize it. Now, you've all heard the news stories about Kerry Stokes or Rupert Murdoch or some other big name celebrity, insert their name here, who hits the news every financial year because they pay practically no tax. So it's the same tax law, folks. There isn't one law for the rich and one law for the poor. It's the same tax law for everybody. So what's the difference between them and us? Well, simple. They go into their accountants every year, pay them a fee, and get their tax planning done every single year to make sure they pay as little tax as humanly possible. So why do tax planning? Well, the obvious one here is to save paying tax. It isn't going to get you on the latest rich list, but hey, who doesn't like having the money in their pocket? And let's face it, the money is going to be much better off in your pocket than it is in the government's pocket because, well, between you and I, they're not very good at spending it. Think of what you could do with the money. You could pay the kids' school fees if that's beginning to stress you out because we're sort of hitting that time of year when the school fees are coming out. You could go on a holiday, you could pay down the mortgage, you could buy a new car, you could buy a new TV, you could go on a shopping spree. You can do anything you want with that money. Or if that doesn't work for you, think of the amount of stress you're going to save. You aren't having big tax bills that you know are lurking around somewhere. You know you're going to have to pay those tax bills to a big organization, aka the ATO, who have deeper pockets, more resources, more time and more energy to be able to actually get the money out of you than you ever will. It also means that come tax time, your accountant is going to be a lot more organized. Because you will have been working with them all year and you will have been working this together all year, they will have all the information they need to be able to get the end of year tax compliance, the boring stuff, done quickly, easily, and efficiently. Now, let's put our sensible hats on for a second. Tax planning is one of those areas that is incredibly highly personalized. So whilst I might be able to run through a few strategies here today for you to give you a few ideas of what you could do, they are by no means exhaustive. And before you implement them or before you go, wow, Alex, thank you so much, you've given me this idea, I'm just going to do it, you need to go away and talk to your accountant first. You need to make sure that this plan or strategy that I have suggested here is going to work for you before you do it. Okay, peeps, let's do this. Tax planning, let's go. Now, I make most of these videos, cards on table for small businesses. However, if you are an individual, that is a taxpayer who has a salary with some investments and a few deductions, and you saw the title of the video and you've actually watched it this far, then this section is for you. For you guys, most of your tax planning involves looking at maximizing your tax deductions. As a very general rule of thumb, you can claim anything that you spend for work as long as it's not reimbursed by your employer. There are some exemptions to this, which your accountant will be able to run you through, but your accountant doesn't know what they don't know. So it's best to take everything to them and let them tell you what you can and cannot have. So some of the more common things that we are seeing coming through on tax returns these days are motor vehicle expenses, off-site parking, laundry allowance, professional subscriptions, working from home expenses, seminars and CPD training, union fees, and income protection insurance. Let's just tackle a couple of points that we just need to cover off on here. For motor vehicle expenses, if you have a vehicle on a novated lease, then you will most likely not be able to claim any motor vehicle expenses in your tax return. And this is because the cost of the novated lease comes out of your pre-tax salary. That is before you pay tax. You also ideally need to be doing a logbook. Without a logbook, we have no flexibility in how we make a claim for motor vehicle expenses. With a logbook, we can actually play around and have a look at what the best deduction is to be able to take in your tax return that will give you the best return possible. Laundry allowance. You can only claim laundry allowance if you are wearing protective clothing, occupation-specific clothing, or a compulsory uniform. With working from home expenses, there have been some changes in relation to this recently, so be very, very careful what you claim. But one of the things you do need to do is keep a diary for your entire year for what you're claiming, and you just need to keep a record of everything that you have spent on your home office. Income protection insurance, you actually need to be paying the premium on that. It cannot be coming out of your super fund. Now, this list is nowhere close to exhaustive. However, they are the more common items that we see coming through on tax returns. Under the current tax rules, post-tax contributions into superannuation are tax deductible. So these are contributions that you make out of your take-home pay, out of your after-tax salary. But there's always a but you need to be careful around super. So before you do anything, have a chat with your accountant or a financial advisor to make sure that what you want to do is actually suitable for your circumstances. Get it wrong and the penalties are huge. So be very, very careful. Another area that you just need to watch out for are capital gains and losses. So one of the questions we get asked all the time is, do we still need to calculate capital gains or losses when we know a loss has been made for the year? And the answer, I'm sorry guys, is absolutely yes. You always need to be calculating a capital gain or loss. If you want to know more about how capital gains and losses in Australia are calculated, I will leave a link to a video I recorded in the description box so that you can watch it after this video. It goes into more detail around how capital gains tax is calculated on the disposal of assets. Small business, let's us have a quick chat. Strategies here can vary significantly, and that's because of the structure you may have chosen for your business. Remember, the best accountants will always guide you to choose a structure that is best for your business and your circumstances. It is not a one-size-fits-all approach in any shape or form. For example, for a trust structure, you might look to distribute excess profit amongst your children. Again, there have been some fairly significant changes in this area of late, so it's not so easy to distribute to children anymore. So you might want to have a chat to your accountant first before you go ahead and prepare the minutes to do that. A bucket company or a self-managed super fund can also be used to help with the distribution of profit and keep taxes to a minimum. But What do you do with all this money? Do you invest it? Do you spend it? Do you leave it in the business? What do you do? If you run a proprietary limited company, you might be looking to pay a dividend out to the owners. Dividends need to be paid equally to all shareholders. So what I mean here is not that you want to pay a total $10,000 dividend and you need to do $10,000 dividends to every shareholder. What I mean is you might be looking to pay $1 per share, and $1 per share needs to go out to every shareholder. A company where you have a husband and wife who are perhaps owning 50-50 in terms of the shares, if one of them is, say, working outside of the company and earning their own income, you just need to be aware that when the dividend gets distributed, that might push their income into a higher tax bracket and actually make it a lot less attractive to be receiving that dividend. That then brings us into, is directly owning the shares in the company the best structure that you could be using in terms of minimizing your tax and managing the flow of tax and flow of money out of the business? Don't you love that? Flow. So you might actually look at it and say, well, maybe a trust holding 100% of the shares gives us more options in terms of how we distribute income out of the business tax effectively. Something just to chuck in here, just to sort of say, be aware, is that if you are going to restructure your business for whatever reason, is you need to be very, very careful about how you do it. The main reason for restructuring a business cannot be the minimization of tax. There needs to be a commercial reason why you would do it or some other reason why you would do it first. If tax minimization is the primary reason for doing it, and that's documented somewhere, then you are skirting on the realms of an area of the law that could land you in a lot of trouble. If you are a partnership, what can we do to help mitigate the tax impact of the partnership distribution at the end of the tax year to all partners? Common across individuals and businesses alike when we are doing tax planning is the review of tax already paid for the year versus the amount of tax that you are expecting to have to pay for the year. It is for this reason that tax planning is generally done in around April, May sort of time, because then if there is a top up that needs to be made, it can be done in the June activity statement. If you don't lodge activity statements, then it gives you enough time to put the money aside so that when your tax return is done, the money is already there because you know roughly what the bill is going to be. Before I go into the more common tax planning mistakes that I see all the time, I just have a question for you. If you've been watching this video this far and you've been enjoying it and you think that I'm giving you some value, why haven't you hit the subscribe button yet? Go on, click on that subscribe button, hit the bell so that you'll be notified whenever I release another one of these useful, value-packed videos. Mistakes. So for individuals, it kind of falls into two buckets. First and foremost, you don't claim everything you should. That just comes down to bad record keeping or poor record keeping, or shall I say sloppy record keeping. You are required, yes, required to provide proof of purchase before you are able to make a tax claim. Now that can be a copy of the receipt, a credit card statement, or a bank statement. There are some fabulous apps out there like My Deductions or Cruncher, or there are hundreds you could go away and have a look at that will help you to organize your receipts and everything that you gather throughout the whole year so that when you go into your accountant, you've actually got something that's neat, tidy, ready to go that you haven't spent hours trying to compile, and they will thank you for it. What they won't thank you for, and I'm going to tell you this right now, is if you pitch up with a shoebox or some other shoebox-like vehicle to be putting your receipts in that are all crunched up, unorganized, faded, dying a death. They will not thank you for that. The days of being able to do that to your accountant are long gone. Give them a little respect, folks. These guys have multiple degrees and postgraduate qualifications. They don't need to be sitting there for hours going through your receipts. So the other area that we see a lot of mistakes in is timing, folks. The Australian tax year runs from 1 July to 30 June. If you've paid for a deduction outside of those 2 dates, then there is nothing we can do about it. You will either lose out because it was last year, or you'll have to wait until next year. For businesses, making sure your bookkeeping is done correctly is the biggest mistake that we see coming in. It's either not up to date, incorrectly allocated, or just simply not complete. I know how easy it is to hand it over to a bookkeeper and say, here, you do this for me. I'm not going to do anything more. Barley's over to you. It's numbers. It's not my bag. It's not my game. It's not what I do. As an FYI, your monthly or quarterly meetings with your accountant are a really good way to prevent this from happening, because you'll be looking at the numbers with them every quarter. Whoever you employ to do your bookkeeping is in effect an employee of your company. They are actually performing the role of a finance function for you on your behalf? Would you allow any other employee to go off and do work sight unseen without checking it first? Hell no, I know I wouldn't. So why do you do it with your bookkeeping? You need to be double checking the numbers to make sure that they are correct. The next biggest mistake that we see is undertaking a transaction without talking to your accountant first. You know it's you. You know you're the one. You know you did it. You go off, you buy some equipment. The finances is in the wrong business name. You go off, you buy a car. You take it home and park it at home, triggering fringe benefits tax. You need to be talking to your accountant first. If you were a large organization, you wouldn't move without talking to your finance team first. Well, your accountant, folks, is your finance team. Okay, that's what they're there to do. They're there to provide financial support for your business to help it grow. Give them a call. But Alex, I hear you say they're going to charge me to do this work. Really? Are you sure? Have you asked them? Many businesses or many accounting practices now actually work on a package fee. So we're the same, we work on a package fee. So we will not charge you for that because it's already included in the package price. And here's another thing. The price or the cost of the FBT, so the tax on that car that you bought, is going to be way higher than the fees that you're going to pay to your accountant if you do need to pay fees to the accountant. While we're just talking about why you don't ring your accountant, because everybody does it, individuals and businesses alike, you all do it because you all think that we're going to charge you for it. We probably won't. Most of us really don't. Like I said before, we've got you on packages, so we don't actually need to be sending and raising invoices for every single phone call that we take during the year. And if we do need to charge you for it, most likely we'll tell you first. Don't just assume that that's what we're going to do. But let's face it, most of the time, does the cost of the tax outweigh the accounting bill? Just saying. Anyway, rant over. One last overarching comment that I have to say around this, and it's all to do with document retention. The ATO and the tax law are pretty strict and pretty clear around this point. You are required, yes, required as the taxpayer to maintain adequate documentation for every single transaction you make. Now, for assets, so things like shares or investment properties or something like that, that means that you have to keep the purchase agreement. So it's everything from the date of purchase right the way through until 5 years after you've sold it. I could stand here all day talking about tax planning and what you could and couldn't do and what the mistakes are and where people go wrong, but I think we'll leave it here before I go down a rabbit hole and while we're still ahead and I still have your interest as we watch it. Thank you for watching to the end of the video. And remember, before you do anything, before you go running off and trying to implement anything I have said in here today, go and talk to your accountant first to make sure it suits your circumstances. And if you don't have an accountant, come and talk to me because I would be more than happy to have a chat with you over a coffee and work out what the best tax planning is for you and your business. Take care, and here's to the start of your tax planning journey.